Stop! If you're investing in crypto, you need to hear this. Are you making one of these deadly mistakes that could wreck your portfolio? In 2025, the crypto market is hotter than ever, but with massive gains come massive risks. Most traders don't realize their mistakes until it's too late. Today, I'll break down the biggest crypto investment blunders people are making right now and how you can avoid them. Stay till the end because I'll share real trader stories of those who made these mistakes and what happened next. Spoiler alert, some lost millions. Hit that like button if you're serious about crypto and let's dive in. FOMO trading is the #1 reason why most traders lose money. It tricks your mind into chasing pumps, leading to bad trades and heavy losses. Back in 2021, thousands of traders jumped into Dogecoin at $0.70 just because Elon Musk tweeted about it. The hype was unreal. People believed it would hit $5 or even $10. But what happened? Doge crashed by over 80%. Many traders lost thousands, even millions. They bought at the top and got trapped in a downtrend. This happens with almost every hype-driven asset. Why FOMO is dangerous? High volatility. Prices spike fast, but they also drop even faster. Emotional trading. You buy based on emotions instead of logic. No strategy. You enter blindly without planning an exit. Bag holder syndrome. You're stuck with a worthless asset, hoping for a miracle recovery. How to avoid FOMO trading. Always research before investing. Never buy just because something is pumping. Check the fundamentals, roadmap, and use case. Ask, is this project strong or just a hype cycle? Stick to your strategy. If you weren't planning to invest in a coin, don't suddenly buy just because of FOMO. Set clear entry and exit rules before jumping in. Follow a risk management plan. Don't risk more than you can afford to lose. Use dollar cost averaging, DCA. Instead of going all in, invest small amounts over time. This lowers your risk and smooths out price fluctuations. Example, instead of buying $1,000 worth of XRP at once, buy $200 every week for 5 weeks. Watch for pump and dump patterns. If a coin is up 100% plus in a day, be cautious. It might dump just as fast. Always check trading volume. If it's low, it's easy for whales to manipulate. Ignore hype and social media noise. Just because influencers, YouTubers, or TikTok traders are saying a coin will moon doesn't mean it will. Remember, many influencers get paid to promote projects. Follow on-chain data, news, and whale movements instead of hype. Set stop-loss orders. If you do decide to enter a trade, always use stop-loss orders to protect your capital. Example, if you buy at $1, set a stop-loss at 0.85 to prevent massive losses. Train your mindset. Patience wins. Successful traders wait for the right opportunity instead of chasing trends. The best investments are made when prices are low, not when everyone is hyping it up. Focus on long-term wealth, not short-term FOMO pumps. Pro trader mindset versus FOMO trader. Pro trader researches before investing, sticks to their plan, uses DCA and stop loss, buys when prices are low. FOMO trader buys when prices are skyrocketing, listens to hype instead of research, doesn't have a clear plan, ends up bag holding losses. The choice is yours. Trade smart or become another FOMO victim. Ignoring market cycles is the costliest mistake in crypto trading. The crypto market moves in predictable cycles, yet many traders ignore this reality and lose money by buying high and selling low. Understanding market cycles is the key to long-term success in crypto investing. In 2021, Bitcoin hit an all-time high of $69,000 during the peak of the bull run. Hype was at its highest, and many investors believed BTC would soar past 100K. Everyone was bullish. Influencers were shouting 200K Bitcoin soon. Institutions were jumping in, adding to the mania. But then, the bear market arrived. BTC crashed below 20K. Many investors panic sold at the bottom, locking in heavy losses. They bought at the peak of greed and euphoria, then sold in fear and despair. Smart money, Big players accumulated BTC at the bottom while retail investors were dumping. This is a textbook example of ignoring market cycles. Understanding crypto market cycles. The crypto market moves in 4 predictable phases, largely tied to Bitcoin's halving events every 4 years. Accumulation phase, bear market bottom. Prices are at their lowest. Retail traders are scared. Media declares crypto is dead after a major crash. Smart investors accumulate Bitcoin and altcoins at low prices. This is the best time to buy, but most people are too afraid. Example: after the 2018 bear market, BTC dropped to 3K. Many thought it was over. But within 2 years, it skyrocketed back to 69K. Bull run begins, pre-halving accumulation. Bitcoin starts recovering, but many still doubt it. Institutions begin accumulating while retail traders hesitate. Early adopters buy BTC and strong altcoins before the next pump. This phase is where fortunes are made. Example: BTC moved from 3K 2018 to 12K 2020 before breaking out to new highs in 2021. Euphoria and FOMO, bull market peak. Prices go parabolic. Everyone is bullish. Retail investors rush in at all-time highs. Media calls Bitcoin the future of finance. Big investors quietly exit, taking profits. Example: Bitcoin at 69K 2021. Everyone expected 100K plus, but smart money was selling while retail investors were buying. Bear market, capitulation and fear. Markets crash hard, weak hands panic sell. Many projects die off and people leave crypto. Bitcoin retraces 80-90% from its peak. Smart money re-enters at low prices, preparing for the next cycle. Example: BTC fell from 69K to 16K 2022 bear market. Those who panicked sold lost big. Those who bought at 16K saw massive gains. How to avoid market cycle mistakes? Learn the 4-year Bitcoin cycle. Historically, Bitcoin moves in 4-year cycles tied to its halving events. Every halving, reducing BTC supply, triggers a bull run 6 to 12 months later. Understanding this pattern helps you time your entries and exits. Buy in the bear market, not the bull run. Best time to buy: when prices are low and everyone is fearful. Worst time to buy: when hype is at its peak and everyone is bullish. Follow smart money. Buy low, sell high. Don't chase green candles. If an asset has already pumped 100 to 500% in a few weeks, wait for a correction. Smart investors accumulate before the pump, not after. Patience is key. Study historical trends before investing. Look at Bitcoin's previous cycles, 2013, 2017, 2021, etc., to see patterns. Learn from past mistakes. Avoid buying at cycle tops. Ignore hype and emotional trading. Just because Twitter, YouTube, and TikTok say a coin will moon doesn't mean it will. Stick to your research and long-term strategy. Use dollar cost averaging, DCA, for long-term gains. Instead of trying to time the market perfectly, invest small amounts over time. This reduces risk and smooths out price fluctuations. Example: instead of buying 10K of BTC at once, invest $500 a month for 20 months. Have an exit strategy. Set profit-taking targets. Don't wait for unrealistic price targets like $1 BTC overnight. Use stop losses and trailing take profits to lock in gains. When retail FOMO is at its peak, start selling gradually. Pro trader mindset versus market cycle victim. Pro trader understands Bitcoin cycles and plans accordingly, accumulates during the bear market, takes profits in the bull run, uses DCA and risk management. Market cycle victim buys at all-time highs due to FOMO, sells at the bottom out of fear, ignores market cycles and historical data, ends up bag holding losses. If you want to win in crypto, trade smart and follow the cycles. Over-leveraging is the fastest way to get REKT. Leverage trading is a double-edged sword. It can magnify profits, but it can also wipe out your entire portfolio in seconds if the market moves against you. Many traders enter leverage trading without understanding the risks, chasing quick profits, only to end up liquidated. Let's break down why over-leveraging is one of the deadliest mistakes in crypto trading and how you can avoid it. A trader on Binance started with $10K and used high leverage, 100x. His position grew massively, reaching $500K in profits in just a few weeks. Instead of cashing out, he got greedy and increased his leverage. A small market dip, only 1-2%, triggered a liquidation. In seconds, he lost everything. This is the harsh reality of over-leveraging. It takes just one bad trade to lose it all. The problem? The higher the leverage, the smaller the price movement needed to wipe out your entire position. Even a tiny market fluctuation can trigger liquidation, erasing all your capital in seconds. Leverage is like playing with fire. If you don't control it, it will burn your entire portfolio. Why over-leveraging is a recipe for disaster? Crypto is highly volatile. Unlike stocks, crypto can swing 10-20% in a single day. With high leverage, even a small price fluctuation can liquidate your position. If you use 50x leverage and the price drops just 2%, you lose 100% of your capital instantly. Market manipulation. The whale game. Big players, whales, intentionally trigger liquidations to profit from retail traders. They cause quick price drops to wipe out leveraged traders and buy back assets cheaper. Bitcoin may suddenly drop $2,000 in minutes just to liquidate over-leveraged traders, then bounce back immediately. Funding fees eat away profits. When trading with leverage, you pay funding fees every few hours. If you hold trades for too long, these fees slowly drain your balance, even if the trade doesn't go against you. Holding a leveraged position overnight can result in huge hidden losses due to these fees. Psychological pressure. Leveraged trading increases stress because every market move feels extreme. Traders panic sell when the market dips and hold on to losses too long, hoping for a rebound. You buy Bitcoin at 50K with 25x leverage. BTC drops to 48K and you panic selling at a loss, only for BTC to bounce back to 55K. How to avoid getting RKT by over-leveraging. If you're new, avoid leverage trading. Leverage is not for beginners. Start with spot trading and build experience before considering leverage. Use low leverage, 3x, 5x max. High leverage, 20x, 50x, 100x, is gambling, not trading. Even experienced traders rarely use more than 5x leverage to manage risk. Always use a stop loss. Never enter a trade without a stop loss order. This limits your losses if the market moves against you. If you long BTC at 40K, set a stop loss at 39K, 2.5% to protect yourself. Never risk more than you can afford to lose. Only trade with money you can afford to lose. If losing a trade affects your emotions, you're overexposed. Pay attention to liquidation price. Before entering a trade, check the liquidation price. If it's too close to your entry price, reduce your leverage or add more margin. Don't chase get-rich-quick schemes. Most traders who use high leverage believe they will turn 1K into 100K overnight, but they usually end up losing everything. Remember, slow and steady wins the game. Final thoughts. Leverage can make or break you. Leverage trading isn't inherently bad, but misusing it can destroy your portfolio overnight. Many traders get lured in by massive profit potential without realizing how quickly things can go wrong. Yes, leverage can 10x your profits, but it can also 10x your losses. If you don't manage risk properly, you will eventually blow up your account. The best traders focus on survival, not just big wins. The golden rules of safe leverage trading. Use leverage responsibly. 3x, 5x max. Set a stop loss on every trade. Never risk more than you can afford to lose. Avoid high leverage gambling, 20x, 50x, 100x, for disaster. Watch out for whale manipulation and liquidation traps. Pay attention to funding fees and hidden costs. Keep emotions in check. Don't FOMO into leveraged trades. Final warning, most traders lose money with high leverage. Statistics show that over 90% of leveraged traders eventually lose their capital. If you want to build long-term wealth, focus on consistent, smart trading rather than trying to hit home runs with high-risk leverage. Trade wisely, protect your capital, and remember, capital preservation is key to long-term success. Not using cold wallets. The oops, I lost my crypto mistake. One of the biggest mistakes new traders make is leaving their crypto on exchanges, thinking it's safe. Reality check? If your crypto is on an exchange, you don't truly own it. Exchanges can get hacked, go bankrupt, or freeze withdrawals. If you're not using a cold wallet, you're taking a massive risk with your assets. Real-world example: the FTX disaster. In November 2022, FTX, one of the world's biggest crypto exchanges, collapsed overnight. Users had billions of dollars stored on the platform. When things went south, FTX froze withdrawals, meaning no one could take out their money. The result? Investors lost everything. Many thought FTX is too big to fail. But in crypto, nothing is guaranteed. If your coins are on an exchange, they can disappear in a heartbeat. Why leaving crypto on an exchange is a bad idea. Exchanges get hacked. Billions of dollars in crypto have been stolen from exchanges over the years. Hackers target exchanges because they hold massive amounts of user funds. If an exchange is hacked, your funds may be gone forever. You don't control your crypto. Not your keys, not your coins. When you keep your crypto on an exchange, you don't own the private keys. The exchange does. This means the exchange has full control over your funds. They can freeze your account for any reason. If they go bankrupt, your money disappears. Crypto regulations can change. Governments regularly crack down on crypto exchanges. If new laws force an exchange to shut down, your funds could get stuck. Your money is only safe if you control it. How to keep your crypto safe. Cold Wallet 101. Use a cold wallet for long-term storage. Cold wallets store your crypto offline, making them immune to hacks and exchange failures. Best cold wallets: Ledger Nano X, S, Trezor Model T, One, Elipal, Keystone. Why cold wallets are safer? 100% offline. No risk of hacking. You own the private keys. Full control over your funds. Immune to exchange collapses. Even if Binance, Coinbase, or Kraken go under, your crypto stays safe. Use exchanges only for trading. Never store your long-term holdings on an exchange. Trade on exchanges, but withdraw profits to your cold wallet. Use decentralized wallets for smaller amounts. Only keep what you need for active trading. Pro tip: set up auto withdrawals to move profits off exchanges regularly. Secure your wallet like a pro. Just having a cold wallet isn't enough. You need to protect it properly. Top security tips: back up your seed phrase, never store it digitally. Use a metal backup instead of paper. Keep it in a safe place, never share it with anyone. Enable passphrases and PIN protection for extra security. Warning: if you lose your seed phrase, you lose your crypto forever. Final thoughts: cold storage is a must for crypto holders. If you're serious about crypto, protecting your assets should be your top priority. Exchanges can disappear overnight. Hacks happen all the time. Regulations are unpredictable. The only way to truly own your crypto is to store it in a cold wallet. Don't wait until it's too late. Secure your crypto today. Chasing SH coins and meme coins, the fastest way to get wrecked. Many traders fall into the get-rich-quick trap of buying meme coins and Shayat coins, hoping to strike gold. But the truth? 99% of these coins are scams, pump-and-dump schemes, or worthless projects with zero real value. They rise fast and crash even faster. If you're not careful, you'll end up holding worthless bags while insiders cash out. Real-world example: the Squid Game token scam. Squid token launched in October 2021, claiming to be part of an upcoming Squid Game crypto play-to-earn game. It skyrocketed from 0.01 to $2,800 in days. Investors thought they had struck gold. Then, the developers rug pulled, dumping their tokens and cashing out millions. The price crashed to $0 in seconds, wiping out thousands of retail investors. Lesson: just because a token is hyped doesn't mean it's safe. If something sounds too good to be true, it probably is. Why most meme coins and shot coins are a disaster. They have zero real utility. Unlike Bitcoin, Ethereum, or XRP, which have strong use cases, Most meme coins serve no purpose. Red flags to watch out for. No real-world application. No innovation, just a copy-paste project. No product, just hype and promises. If a project only exists to make insiders rich, it will fail eventually. Most are pump and dump scams. Early investors pump the price to lure in retail buyers. Once enough people buy in, insiders dump their holdings for massive profits. The price crashes, and regular investors lose everything. Examples of pump and dump coins: BitConnect, Save the Kids, SafeMoon. If a coin only pumps due to hype, it will crash. They rely on hype, not fundamentals. Eshed coins thrive on hype from social media, influencers, and celebrities. Warning signs: if a coin's only marketing strategy is to the moon, it's likely garbage. If influencers are promoting it without a real use case, run. If the project's roadmap has no clear development goals, it's a red flag. Example: Logan Paul's Crypto Zoo project promised to be a game changer, but ended up being a massive failure. How to avoid getting wrecked by shitcoins and meme coins. Research the project thoroughly. Before investing in any crypto, ask yourself these questions. Does it solve a real problem? Who is the team behind it? Are they anonymous? If yes, does it have a working product, or is it just hype? Is there a roadmap with clear milestones? Is the liquidity locked, and is the contract audited? If you can't find solid answers, don't invest. If a coin has no use case, it's probably a scam. Hype doesn't equal value. If a coin has no real-world application, it's a ticking time bomb. Good projects have a real product, strong partnerships, and a solid team. Actual utility that goes beyond memes and hype. Bad projects just exist to pump, dump, and disappear. Diversify, never go all in on one coin. A golden rule in investing: don't put all your money in one basket. Spread your investments across blue-chip cryptos, high-potential altcoins with real use cases, stablecoins for liquidity. If you YOLO all your money into one meme coin, you're gambling, not investing. Take profits and don't get greedy. If a meme coin pumps 10x or 100x, take profits. Mistake many traders make: they wait for even higher prices and never sell. The price crashes, and they lose everything. They get stuck holding a worthless bag. A winning trade is only real when you cash out. Final thoughts: be smart, not a bag holder. Yes, some meme coins explode, but most crash. The key is knowing when to invest and when to stay away. Do your research. Avoid pump and dump scams. Diversify. Don't go all in on hype. Take profits before it's too late. If a coin has no real value, it will fail eventually. Falling for crypto scams and rug pulls, the silent killer of your portfolio. If it sounds too good to be true, it probably is. That's the golden rule when it comes to crypto scams. They often promise guaranteed returns, insider access, or quick, easy profits. But in reality, they're just looking to exploit your greed and ignorance. The truth is, the crypto world is filled with unscrupulous actors who are only in it for their own gain, leaving unsuspecting investors in financial ruin. You need to recognize the signs of a scam before it's too late. Example: BitConnect, the Ponzi scheme that stole billions. BitConnect promised guaranteed returns of up to 40% per month, a ridiculous figure that should have raised red flags. The project claimed to use a trading bot to generate profits. In reality, it was just a Ponzi scheme that paid returns to earlier investors with the money from new ones. As soon as BitConnect was exposed, the coin's value collapsed, and many investors lost everything. Why crypto scams and rug pulls are so dangerous. Crypto scams have become more sophisticated and deceptive than ever before. From fake ICOs to rug pulls and Ponzi schemes, scammers are targeting inexperienced investors with promises of huge gains and minimal risk. Unrealistic promises of guaranteed returns. One of the biggest red flags for any crypto project is when it promises guaranteed returns. No legit project can guarantee profits because the market is volatile by nature. Scams often lure you in with promises like earn 100% in 1 month, guaranteed passive income, zero risk investments. If a project is guaranteeing returns, it's not legitimate. Legitimate crypto projects are transparent, and volatility is part of the game. Anonymous developers and lack of transparency. Most scam projects operate under the guise of anonymous developers. This creates a lack of accountability, making it nearly impossible to track or confront the creators when things go wrong. Red flag. No one knows who's behind the project or their track record in the industry. Example, BitConnect. The platform was run by anonymous developers who disappeared once the scam was exposed. Solution. Always research the team behind the project. Real projects are usually transparent and their developers have a public presence and valid credentials. Remember, if you can't find any information on the developers or their past projects, don't trust it. Influencers hype and pump new coins. Social media hype and influencers are often used to pump up new coins. Scammers pay influencers to promote new projects, creating an illusion of legitimacy and excitement. This creates a FOMO effect, leading people to jump into the project without doing any research. Example, a popular YouTube influencer or Twitter personality might shout out a new coin, claiming it's the next big thing. These endorsements can lead to massive price pumps, but once the hype dies down, the price crashes, and investors are left holding bags of worthless coins. Red flag. If influencers are hyping a coin but lack transparency on how they're connected to the project, it's likely a scam. Pump and dump schemes. The classic scam. Pump and dump schemes are one of the oldest tricks in the crypto scam playbook. How it works. Scammers buy up a low-volume coin and artificially inflate its price. They then promote the coin via social media, influencers, or fake news articles to get others to buy in. Once the price is high enough, the scammers sell off their holdings, leaving investors with worthless coins. Example, the Save the Kids token scam in 2021. Multiple influencers pumped the price, then sold their bags at the top, leaving investors with nothing when the price crashed. Ponzi schemes, the false promise of never-ending profits. Some crypto scams operate like a Ponzi scheme, where new investments are used to pay returns to early investors. How it works. Investors are promised consistent returns, and those returns come from the funds of new participants, rather than any actual profit-generating activity. Eventually, the scheme collapses when the flow of new investors slows down, and the early investors are left with nothing. Example, OneCoin, a crypto Ponzi scheme that promised huge returns, but eventually scammed billions from its investors. How to protect yourself from crypto scams and rug pulls. No legit project guarantees returns. The biggest red flag is any project that guarantees returns or promises low risk with high rewards. No legitimate project can promise consistent profits. Real projects are transparent about the risks involved. Trust your instincts. If it sounds too good to be true, it probably is. Always research the developers. Look for a publicly known team with a clear background in the crypto space. Avoid anonymous developers or teams with no verifiable information. Legitimate projects usually have LinkedIn profiles, public interviews, and social media accounts that are active and verified. If you can't find credible information about the team, move on. Be skeptical of influencer hype. Influencers might get paid to shill projects, so always research a coin yourself. Don't let FOMO drive your decisions. Focus on the long-term value of the coin instead of short-term hype. Stick to well-established coins with proven track records. Focus on well-established cryptos like Bitcoin, Ethereum, and XRP that have real-world utility and credible development teams. Avoid coins with no roadmap, no utility, and no real-world application. Use trusted exchanges and wallets. Use reliable exchanges like Coinbase, Kraken, and Gemini. Avoid small, unregulated exchanges. Always store your crypto in cold wallets for long-term security. Final thoughts. Don't fall for the hype. Crypto scams are on the rise, and falling for them can lead to devastating losses. Stay vigilant and always remember, if it sounds too good to be true, it is. Research, diversification, and skepticism are your best defense against falling into the scam trap. Did any of these mistakes surprise you? Comment below. Which mistake do you think is the worst? Want more crypto insights? Smash that subscribe button and turn on notifications so you don't miss my next video. Follow me for daily crypto updates. Instagram, TikTok, YouTube, X, Threads, Snapchat, Medium, True Crypto Insights. Podcast, CryptoTribex. Blog, truecryptoinsights.blogspot.com. Like, share, and subscribe for more crypto wisdom.